I'm Daniel.
And I'm Mira.
So, picture this scenario for a second. Global oil routes in the Middle East are essentially blockaded.
Right.
Energy prices are going completely parabolic. And yet, if you look around the U.S. domestic economy, consumers and businesses are out there buying heavy machinery and breaking ground on new houses at just a blistering pace.
Yeah, it's wild.
Today's of Wednesday, April 29th, 2026, and our mission for today's daily briefing is unpacking a market that is, frankly, defying a whole lot of traditional financial logic right now.
It really is. I mean, we are looking at a choppy, range-bound equity market today that somehow successfully absorbed massive crude oil spikes and climbing Treasury yields.
Yeah.
All while navigating this historic divide at the Federal Reserve. It's one of those days that forces you to rethink how all these moving pieces actually fit together.
Absolutely. Now, before we jump into the timeline, a quick reminder. This briefing is for market context and discussion only. It should not be taken as personal investment advice or an investment recommendation.
Exactly. We're just here to help you understand the baseline you're operating against. You know, we map the terrain, but you decide which path to walk.
Well said. So let's open our first session of the day. What set the stage before the U.S. session today? Because honestly, Mira, if you looked at any trading screen this morning, you saw absolute wild price action in the commodities complex.
Oh, yeah, completely.
Crude oil was the undeniable standout, and it wasn't just a minor blip either.
Not at all. We saw WTI crude, which is West Texas Intermediate, the primary U.S. oil benchmark stage, this massive surge early in the morning.
Right.
It hit an intraday high of $108.49 before finally settling slightly lower at $106.88.
Which is still huge.
Yeah, and Brent crude, which is the broader global waterborne benchmark, that settled up over 6% at $118.03 a barrel.
Wow.
And for context, when Brent pushes past that 115 mark, that is the kind of price point that physically breaks corporate logistics models.
Yeah, it starts bleeding into everyday household budgets real fast.
Oh.
And the mechanism driving the sudden squeeze isn't just some vague sense of global unease. We are talking about tangible, physical blockages.
Right, real physical constraints.
You have the ongoing U.S. maritime blockade in the Strait of Hormuz. And then at 8:12 a.m. Eastern time this morning, the CEO of Total Energy came out and stated point blank that they will not restart operations until the region actually stabilizes.
That's a massive deal.
Yeah. They literally had a tanker with company cargo exit the Persian Gulf, and they're now essentially pausing operations in the region.
I mean, that is a massive corporate player effectively telling the global market that the water is just too hot.
Yeah.
When an oil major pulls its tankers, the insurance premiums for every other vessel in the region instantly skyrocket.
Right, and that friction immediately prices into the barrel.
Yeah.
And you pair that physical disruption with a major carryover narrative from Tuesday's session regarding the United Arab Emirates.
Ah, yes, the UAE drama.
We had that shocking announcement yesterday, April 28th, that the UAE is exiting OPEC to prioritize its own long-term economic strategy.
And today, the rumor mill was absolutely out of control.
It really was. Rumors were swirling about an immediate withdrawal by the UAE. Former President Donald Trump publicly praised the move, saying it was great for lowering prices.
Even though UAE officials were actively out there today denying any immediate changes to their status.
Exactly. And, you know, it's so tempting for investors to look at all of this, the Hormuz blockade, the tanker seizures, the UAE drama, and just throw up their hands, treating it like some unpredictable natural disaster.
Yeah, it's the classic hurricane hitting the market fallacy.
Exactly. But I have to push back on that reflex. What we are watching is geopolitical brinkmanship as game theory leverage. We don't need to rehash the entire theory today, but Trump's blockade enforcement and Iran's posturing, they're highly calculated moves.
Right, they're not random.
No, the players are maximizing their leverage right up until the last second to force a favorable deal. It looks like chaos, but it's negotiated chaos.
And that framework is essential if you're trying to position a portfolio right now. But what is truly fascinating to me is how the domestic U.S. economy is completely shrugging off that chaos, at least on the surface.
Oh, absolutely. The data this morning was shocking.
Yeah, right before the opening bell at 8:30 a.m. Eastern Time, we got the Advanced U.S. Core Durable Goods Report. Now, core durable goods are big-ticket, long-lasting items. Think industrial machinery, computers, heavy equipment, but it excludes volatile sectors like defense and aircraft.
So it's a great proxy for underlying business investment.
Exactly. And it grew by 0.9%.
That alone is strong, but the housing data is what actually stopped me in my tracks today.
Oh, the housing starts?
Yeah, housing starts surged a massive 10.8%. That is incredible resilience.
It really is.
Think about the mechanics there,
Yeah.
Oil is skyrocketing, mortgage rates are elevated, and the U.S. economy is still out there buying heavy factory machinery and pouring concrete for new houses.
It points to a real no-landing scenario for the U.S. consumer and businesses. They locked in their fixed-rate debt from years ago, and they're just powering through.
But it's vital to recognize that this resilience is not evenly distributed globally.
Oh, definitely not. If you look up north at 9:45 a.m. Eastern Time, the Bank of Canada held their policy rate steady at 2.25%.
Right.
And Governor Tiff Macklem specifically called out U.S. tariffs and global energy prices as immense uncertainties.
That is a classic central bank trilemma for Canada right now, isn't it?
Precisely. Macklem essentially warned that these external shocks could force their hand in either direction. Think about how this actually works.
Okay.
If the U.S. imposes heavy tariffs, Canada's export economy gets squeezed, which means they might need to cut rates to stimulate growth.
Right.
But if they cut rates while the U.S. holds steady, the Canadian dollar weakens.
Which makes their imports more expensive.
Exactly, thereby importing inflation. So they are basically paralyzed, waiting to see what the U.S. does next.
So to wrap up this first session, before the U.S. markets even fully spun up today, we had this perfect storm brewing. Hot domestic economic data, soaring global oil prices driven by physical bottlenecks, and allied central banks loudly warning about the fallout.
Yeah, quite the morning.
And all of that was just the opening act for the main event. We are going to take a quick breather here and then transition into how the Federal Reserve handled this exact mess.
Welcome back. Let's move right into session 2. What moved markets during U.S. trading hours?
Because every single conflicting data point we just discussed landed squarely on the desk of the Federal Open Market Committee today.
This was the defining moment of the day. 2:00 p.m. Eastern Time. The market is holding its breath. And what did the Fed actually do?
They held the benchmark rate steady at 3.5 to 3.75%.
Right. But the hold itself was universally expected. The real earthquake here was the internal rift.
Exactly. We saw a massive 8-4 split vote on this decision. Yeah, to put that in perspective for you, that is the highest number of opposing votes at the Fed since October 1992.
1992, that is an absolute lifetime ago in market years.
Right. To have 4 dissenting votes on a modern Fed committee means the internal consensus is completely fracturing.
Mm-hmm.
So break down the mechanics of this dissent for us, Mira. What were they actually arguing for?
Well, the committee is pulling in completely opposite directions because the macroeconomic data is so scrambled.
Yeah.
3 of the dissenters, Hammack, Kashkari, and Logan, oppose the easing bias in the statement.
And for anyone unfamiliar, an easing bias is subtle language in the Fed's statement that suggests their next move is more likely to be a rate cut than a hike.
Right. Those 3 wanted a more hawkish posture. They wanted the statement to reflect that tighter monetary policy might still be needed to fight sticky inflation.
But then you have a 4th dissenter, Mirren, who voted in favor of an immediate quarter-point rate cut.
Exactly. So you literally have members staring at the exact same economic dashboards, and some are screaming inflation is too hot, while another is screaming the economy is cracking, we need to cut.
It really tells you how difficult this environment is. How did Chair Jerome Powell try to thread this needle during his 2:30 p.m. Eastern Time press conference?
Powell was surprisingly candid, actually. He noted that inflation is, in his words, misbehaving.
Misbehaving.
Yeah, and he attributed that misbehavior largely to those global energy prices and the lingering effects of tariffs we talked about in session 1.
Which makes sense.
We often refer to energy sharks as a lagged consumer tax, and that framework perfectly explains why the Fed is paralyzed right now.
Yeah, when crude spikes to $108 a barrel, that money drains directly out of your wallet at the gas pump.
Exactly. The Fed knows this acts as a drag on economic growth, so they are forced to just sit on their hands right now. They have to wait and observe how this specific tax destroys consumer demand before they commit to hiking or cutting.
And as if parsing that dual mandate wasn't hard enough, we have a massive succession drama playing out right in the middle of it.
Oh, the timing is just incredible.
Right. At 10 a.m. Eastern Time today, the Senate Banking Committee advanced Kevin Warsh as the nominee for the next Fed chair.
Yeah.
It was a straight party line vote, setting up a full Senate floor vote after their May recess. And during his presser, Powell confirmed he intends to stay until his term officially ends on May 15th.
Which creates a very tense transition period. I mean, if you are an institutional investor, you're now looking at a highly divided committee, a completely uncertain inflation path, and an imminent change in leadership all happening simultaneously.
And this is exactly where I have to challenge the broader market's reaction today.
Okay, let's hear it.
Because the S&P 500 closed essentially flat, ending at 7135.95.
Right.
But the 10-year Treasury yield, which tracks the bond market's expectations for growth and inflation, climbed to 4.418%. We know that discount rates act as gravity on valuations. Mechanically, when that 10-year yield marches higher, you can get a 4.4% return virtually risk-free.
Right.
That gravity is supposed to pull equity multiples down because stocks suddenly look less attractive by comparison. Are equity markets just getting too complacent here? We're looking at the friction of a deeply divided Fed navigating a leadership transition while rates march higher and the stock market is just yawning.
It's a very fair challenge, Daniel. The equity market seems to be looking right through the monetary policy uncertainty, banking entirely on corporate earnings to act as a shield.
Yeah, they're betting that corporate growth will outpace the drag of higher interest rates.
Exactly. But that shield is going to be severely tested, especially because the geopolitical squeeze did not end when the stock market closed.
Oh, right, the sanctions.
Late in the session at 4:38 p.m. Eastern Time, Treasury Secretary Bessent went on television and announced secondary sanctions on Iranian oil buyers.
And secondary sanctions are a massive escalation compared to primary sanctions.
Oh, totally.
Primary sanctions just mean U.S. companies can't do business with Iran. Secondary sanctions mean the U.S. will penalize any foreign company or country that does business with Iran.
Right, effectively forcing the rest of the world to choose between the U.S. financial system or Iranian oil.
They are specifically seeking the forfeiture of Iran-linked oil tankers and seizing crypto assets.
It ensures that the economic pressure on the global energy trade remains at an absolute boiling point.
Right. So to summarize our second session, the Fed delivered a hawkish hold characterized by a historic level of internal division. That friction bumped Treasury yields higher, while the U.S. government simultaneously turned the screws even tighter on the global oil trade.
It's a lot to digest.
It really is. Let's take a beat and then move into our final session of the day to see how the corporate world is actually handling all of this gravity.
All right, welcome back. Let's open session 3. How did corporate events unfold and what should we watch next?
We just talked about rising Treasury yields acting like gravity. How do these massive tech companies defy that gravity? How does the S&P 500 stay flat on a day like today?
By delivering absolutely flawless earnings.
Yeah.
To justify their massive valuations in a 4.4% yield environment, big tech had to prove that their historic spending is translating into real, tangible growth.
And right around the closing bell today, we got the heavy hitters. Alphabet, Amazon, Meta, and Microsoft all released their first quarter earnings.
Yeah, the AI spending spree is really the defining corporate story of our time. So what did the actual scorecards look like?
Well, Alphabet was the major standout here. They cited their strongest quarter ever for consumer AI plans.
Nice.
But the detail that matters most for the broader economy is where the money is physically going. Alphabet's CFO noted that roughly 60% of their technical infrastructure investment in Q1 went straight to servers.
Yeah, 60%.
Yeah, with the remaining 40% going to data centers and networking equipment. The market loved that clarity. The stock popped 4 to 6% in extended trading.
But it wasn't a clean sweep across the board for the mega caps, was it?
No, it wasn't. Meta actually dropped about 5 to 6% in extended trading. And you have to understand, it wasn't because their core advertising business is failing. It was entirely due to higher capital expenditure guidance.
Ah, right. This perfectly highlights AI Capex as an existential arms race.
Exactly.
These hyperscalers, the massive cloud providers, they feel they have absolutely no choice but to spend aggressively on compute power, cooling, and real estate.
Even if Wall Street punishes their near-term profit margins.
Exactly. Because if you don't build the servers today, you lose the AI war tomorrow.
And building those servers is running into physical, real-world bottlenecks. There was a fascinating micro detail that leaked out at 3:18 p.m. Eastern Time today, right before the close.
Oh, what was that?
Meta is actually extending the life of its older non-AI data center servers from 6 years to 7 years.
Wait, really? From 6 to 7 years?
Yeah. And the reason? Severe memory chip and hard drive shortages that are expected to constrain server supply all the way through 2027.
That's wild. Think about the physical constraints that implies. You can't just throw billions of dollars at a problem if the fabrication plants haven't built the silicon yet.
Exactly. The hyperscalers are sucking up so much advanced silicon for AI development that they're literally having to duct tape their legacy cloud infrastructure and stretch it for another year.
And running a server for a 7th year means higher failure rates and brutal power inefficiencies.
Yeah, it's not ideal. And while the back-end data centers are physically constrained, the push to get AI directly into the consumer's hands is accelerating.
Oh, yeah. Earlier in the day, at 12:25 p.m. Eastern Time, Bloomberg reported that Apple is planning a major visual AI and Siri camera overhaul for iOS 27.
Right, which is slated to be announced at WWDC. They're folding visual intelligence directly into the camera app.
Which perfectly closes the loop on why Alphabet and Meta are spending billions on servers. The end goal is to have the back-end compute power ready to process all of those visual AI queries coming from millions of edge devices.
Like your iPhone.
Exactly, in real time.
It is an incredible multi-billion-dollar feedback loop.
Yeah.
Watching all this unfold today. Well, the market survived a day where crude oil spiked to $108 a barrel.
And the Fed held rates steady in an 8-4 vote.
Right. It turns out getting central bankers to agree on policy right now is harder than getting a container ship safely through the Middle East.
Yeah, but look on the bright side. With Meta keeping its old non-AI servers running for an extra year due to memory shortages, your outdated tech gadgets aren't the only things clinging to life.
Exactly. Have a great evening. And remember to gas up your car before Jerome Powell has to hike rates again.
I love that. A little levity to balance out the macro chaos.
We need it today. So looking ahead, what are the key economic catalysts we need to be watching for tomorrow, Thursday, April 30th?
Tomorrow is an absolute data dump morning.
Oh boy.
Yeah, at 8:30 a.m. Eastern Time, the Bureau of Economic Analysis releases the Q1 advanced GDP estimate, plus March personal income and the critical PCE inflation data.
Now, PCE, the Personal Consumption Expenditures Price Index, is the Fed's preferred inflation gauge. And it is landing less than 24 hours after their hawkish hold today.
Right, and at the exact same time, 8:30 a.m. Eastern, the Bureau of Labor Statistics drops the Q1 Employment Cost Index, or ECI.
Which is the most comprehensive measure of labor costs.
Yeah, it's a vital read on wage inflation. If wages are accelerating while oil is spiking, that 8-4 Fed split we saw today is going to look even more stressed.
Oh, absolutely. Then at 10:30 a.m. Eastern Time, we get the EIA Weekly Petroleum Status Report. The Energy Information Administration's data is going to be crucial to watch given the $108 oil print today.
We really need to see exactly what domestic U.S. inventories are doing while the Strait of Hormuz remains bottlenecked.
Right. And finally, at 4:00 p.m. Eastern Time, the Treasury releases its final report on foreign holdings of U.S. securities.
That is a packed schedule. It could easily challenge the range-bound equity action we saw today.
Absolutely. So to wrap up our deep dive today, I want to leave you with a thought that builds on what we just discussed about Meta's server extensions.
Okay.
Think about this. If the hyperscalers, the Amazons, the Googles, the Metas, are hoarding all the chips, all the power grid capacity, and all the capital for AI, forcing them to stretch their own traditional servers an extra year.
Yeah.
What happens to the innovation cycles and the IT budgets of all the non-AI businesses relying on that legacy cloud infrastructure?
Oh, wow.
Are we looking at a silent tech deficit building up for the rest of the economy while the giants fight their existential arms race?
That really is the multi-trillion-dollar question for the next decade.
It really is. Let us know in the comments how you're navigating this divergence between AI spending and traditional tech.